Good morning, everyone, and welcome to this SIFTA webinar on financial planning and modeling for microfinance institutions. My name is Grzegorz Galusek. I am part of the Microfinance Center. Let me tell you a few words about the logistics of this webinar. It will last about 2 hours. That includes also time for questions and answers. This webinar is recorded, which is one of the requirements of our sponsor, the European Commission. We will share the presentations that you will see and follow today. And obviously, as at any other event of this type, we kindly ask you to make this webinar as interactive as possible. So please feel free to ask questions. You can use the chat box or make yourself visible or switch the mic for you. And you can also ask questions directly to the experts. So today we will explore how to build and use financial models effectively, and our expert will guide us through what would be an ideal structure for strategic and operational models. Also, he will tell us how different departments fit into these models, how to use them to crucial stress testing, and importantly, how to present these insights clearly to your boards and stakeholders. And I'm delighted to introduce our expert. Those of you who have participated in yesterday's webinar already probably are you met Artur yesterday at yesterday's webinar. Artur Munteanu brings over 24 years of leadership in finance and MSME development. Artur is the former CEO and board member of Microinvest in Moldova, and this institution has over 200 million in assets today and a team of over 200 people, so quite a robust, one of the biggest probably regional MFIs in the region. Artur also serves as an advisor and board member in different institutions working in diverse sectors. He holds an MBA from the University of Hull in the UK. So let me just say a few words about our sponsor, and that is European Commission, which created InvestEU, one of the largest, if not the largest, investment programs in European Union that promotes innovation and competitiveness, also job creations. And as part of that, it created special instruments for the social economy sector, including social finance and microfinance. It consists of 3 different legs. One leg is financial instruments, mostly in the form of guarantees. These guarantees unlock a lot of private sector and make it invest in different sectors. The other part is the advisory part, the advisory hub, which where SIFTA, of which SIFTA is part of, and also there is an InvestEU portal. SIFTA, as you can see, stands for Social Inclusion Finance Technical Assistance. It provides on one side advisory services, capacity building, and market development services. On the other hand, also rating, assessment, and evaluation of the institutions that participate in SIFTA. And the reason for SIFTA engaging in evaluation and And rating is that that most of you probably are familiar with the European Code of Good Conduct. This is the EU standard for microfinance institutions, and those MFIs, those institutions that would like to benefit from the EU funding, there is a requirement that they are also certified on the Code of Good Conduct. So within the program, we help institutions both ways. One way to provide technical assistance in different areas of the operations, governance, strategy. That's on one hand. On the other hand, we also help institutions get ready for the certification process. We can provide dedicated technical assistance to review the systems and check the readiness of the MFIs to apply for the Code of Good Conduct evaluation and then being certified. So let's maybe move to the next slide. I would like to say, previous slide. I meant previous slide. I also wanted to say who implements the SIFTA program. The SIFTA program is implemented by the Frankfurt School of Finance and Management. This is the lead partner of the program, together with the Microfinance Center, European Microfinance Network, and FEBA. That's the part that's responsible for advisory services, and technical assistance and training to MFIs. That's on one hand. The other hand, Microfinance rating, which is a global rating institution. Okay, so let's now move to the next slide. This you can still apply for SIFTA. This program has been extended till the end of 2025. Although we know that there are discussions to extend the program even further. So please feel free to take advantage of it. All of the technical assistance is provided free of charge, and the institutions also have access to a rich program of study and peer-to-peer visits, also events organized around SIFTA that are meant to build capacity of MFIs, provide networking opportunities, eventually contributing to growth of these institutions. It's very easy to apply. You just need to send an email to this SIFTA email address that you can see on this slide, sifta@eib.org, and you'll receive an application form that you need to fill out. And on the basis of this application, our EIB partner will qualify you to the program. Okay, so maybe a couple of words about the upcoming events. We have a SIFTA webinar on the topic of internal audit for microfinance institutions and social economy providers, and that webinar will take place on Thursday, 22nd May at 1. Our webinars are usually at 11, so please pay attention to this change of time that is caused by the location of our expert, Piotr Koryński, who is US based. So that's one announcement. Then we also, I'd like to invite you to the MFC annual conference that will take place on the 27th May, and it's, let me tell you, that it's one of the greatest events. It's shaping up as one of the greatest events, not only MFC but in financial inclusion ever. We have an incredible number of participants and high-level speakers that will take part in this conference. The topics will range from new investment opportunities, digitalization, climate change, sustainable agriculture. Also, we'll study the crisis, the crisis that the microfinance sector suffered in Cambodia, to draw lessons learned from it, and many others. So please feel free to check out the agenda of this event and sign up for it, because I think we are in the last 2 weeks of preparations for this event. Finally, let me also announce the last webinar in our short series of MFI Essentials. Let's call it like that. So yesterday we had one essential webinar on micro equity instruments and how to build a suite of products that go beyond microcredit. We also heard about the rationale for it, and also the impact it may have if and potential ways to do it. And tomorrow we will have also webinar on credit scoring for small MFIs. So the third one in our series of essentials for MFIs. So yesterday microequity, today financial planning and modeling, and tomorrow we will have a webinar on credit scoring for small MFIs. Okay, so Artur, before I pass the mic to you, I wanted also to ask you a question regarding today's webinar, if you don't mind. So if you take into consideration all of those complexities and uncertainties that microfinance institutions currently face, from all sorts of regulatory changes, market fluctuations, geopolitical impact. In your view, what is the single most critical benefit microfinance institution can gain by mastering financial planning and modeling right now in the current circumstances?
Dear Gregor, thank you for presentation and for good question. Actually, everybody is saying, why shall we plan if there are a lot of uncertainties?
Everything is changing all the time.
Well, I'll answer with another question. If you don't plan your travel or your trip, do you know where you'll arrive?
Exactly.
You don't know where you'll arrive unless you're a type of traveler which is traveling without any target or objective. But basically, financial planning and financial modeling is helping you to deal with uncertainty, because you're assuming, you have key assumptions, and you work with your team to respond to several opportunities or risks. Let's not talk only about risks, because there are always opportunities, even in a war or in a crisis, there are always opportunities. And I'll be discussing today about opportunities as well, not only about risks. So actually, you can plan opportunities and risks, and you can calculate the impact of one factor or several factors on your trip, on your business trip, on your future MFI. There are different stakeholders within MFIs. There are different shareholders. They have different objectives, different growth objectives, different risk appetite and objectives, and need to model all those and show that if you are making money and impact, or you're not making money, you're not making a profit, you're not making an impact. Yesterday, we also discussed about MFI's mission, stated mission. How do you translate that mission into numbers and into models without having a mission drift or objective drift. Yeah. So today you'll be hearing about financial planning and financial modeling, not only about modeling, not only about key formulas or Excels. It's not about coding, it's not programming. It's about financial planning first and then modeling. And you need the team for that. We'll be talking during our training. You need the team, yes? If your CEO is saying, okay, just do me a budget for next year, that's not enough. It's not enough because you need some inputs. It's a teamwork. So this is what we'll be discussing today. We'll be discussing about financial planning, financial modeling process, the team you need to do, the presentation that you need to have for your shareholders and for your board members and your potential lenders. So I hope I answered your question. Even in highly uncertain environment, I recommend to assume opportunities and risks and to plan and model, because when you plan your trip, you arrive somewhere, and with the same with the financial model, you plan something and you monitor. You monitor monthly or weekly your progress. It's about monitoring the progress. It's not about showing a high profit or high impact. It's about monitoring the process. And for monitoring the process, you need to have a benchmark. You need to have some numbers to compare with every week and every month and every quarter. So it's not about a document that you need for a lender. It's a working tool. It's a working tool. This is what I'm advising. It's a working tool for you as managers of MFIs. I would like to ask participants to write in chat their current position, just to understand the participants' background. Your function, are you financial analyst, are you manager or board member? It'll be interesting to hear a few more words about you, dear participants, because this is for you to solve your challenges. And feel free to ask questions by writing them in the chat. We'll help you to solve your current challenge.
Yeah, it'd be great if you could say your name, institution, and position within the institution. It will give us guidance how to maybe shape this webinar.
So the webinar was designed for
fit your needs.
microcredit. Please write in chat. I'll continue, and I'll read after that in the chat. So the webinar was designed for microcredit, microfinance institutions, but also for social providers. It can be incubators, can be funds, microequity fund, mezzanine funds, platforms. So it's not only for microfinance institutions, it's for broader range of legal forms and business models. And this will help you to diagnose your current status of your financial planning. And one of the benefits of the financial planning is the stress test, that you can actually stress test and prepare better for next quarter, next month, and next years. We'll discuss about elaborating from zero a new financial plan or improving your existing financial plan and financial model. We'll be discussing about how to make faster and better informed decisions, how to understand the team that you need and the skills you need for the financial plan and stress testing, how to present the financial model and stress test to your board and lenders, how to set priorities for developing your financial plan, either from zero or improving your financial plan. This is what we want to discuss. And how to actually manage better your microcredit, social, or your impact financial institution or intermediary, to manage better between risks and profit appetite, between risk, impact, and profit appetite. To faster take decision based on data and calculations. If you say that inflation will go up, okay, what is the inflation going up by 4 basis points on your business? What opportunities exist with inflation, if something exists? That I'm sure there are always opportunities. So we'll help you to better manage risks that exists. Okay. Agenda. So we'll talk about inputs. You need key inputs. If you're a financial analyst, your top management is asking you to do a model, not a plan, but a model in Excel, you need to ask them about key assumptions, because you as an analyst, you're not a financial manager, you're not deciding, you are implementing something. You need to know the growth of the portfolio, the number of products for next year, the allocation of portfolio per product. So you need some inputs. And those inputs needs to be done during the financial planning sessions with salespeople, maybe with clients. So you need important input in the models. Good model is good, presentation and formulas, but excellent model is good input into the model. So like macro aspects, what is going on with remittances, with the economy, with the GDP growth, with your local economy, products, channels. Are you planning a new channel? Is it a mobile channel? Is it a hybrid mobile web and branches? Is it mobile branches? Do you buy a car to travel and sell your products? Do you buy bicycles to sell your products? Operation and admin inputs, operation cost, admin cost. You're planning a new headquarter, you're planning 10 branches, you're planning to cut branches and move completely online. And of course, funding. How are you going to fund your business? Are you going to fund your business via savings, by savings and loans, loans from banks, loans from DFIs, loans via bond issue, who will give you this insight? So you'll need to talk with your CFO and CEO, with your partners, shareholders. Are they going to increase the equity? Or you'll show that if you grow by 30%, you need to increase the equity. So these are the key questions you'll be asking and you'll be assuming, and then you'll be calculating. So the second part of our training today is calculations. And then we have the output of our model, which is cash flow, profit and loss account, balance sheet, financial indicators and covenants, and summary output. And we've seen very detailed financial models, but no summaries in there. So if there are no summaries, that means it's very hard for your stakeholders, your client, which ordered the financial plan and financial model, to read it. They don't have time to read 40 pages in Excel. They need a nice summary. We'll be talking about stress test and sensitivity. You need to stress test your model. And we'll give you some definitions and terminology. And this training is not only for juniors or financial analysts, but also for middle managers and top managers, because we need to work as a team. We need to work as a team to have a very good financial plan and financial model. Let me quickly look in the chat if people presented and for those that have not written their position, I'll appreciate you to write your position, your current position in your company, so that I better understand the participants' role and needs. Okay, we are continuing. We have a poll, and I'll ask Olivia to put the poll out. Ask you to quickly answer the questions here. Are you satisfied with your financial model? Yes, and you have a few answers. We do not have a model. We want to build one. We're not satisfied. We intend to build one. So please quickly answer. We intend to buy software for financial modeling. So there are a few answers here. Please quickly answer. Okay. Okay, so 71% of the participants of those that answered the poll are mentioning that they have a financial model with basic key financial statements and cost. Okay, good. That's why you're here, to learn about more details, stress test, new product, portfolio growth, modeling, and assumptions. Okay, great. Thank you very much. Okay. Okay, financial planning process. So we need to start. And when we need to start the financial planning process, ideal situation, CFO and CEO writes a memo and inform the whole company. Inform the team that we're in the process of budgeting. We're the process first of planning and then budgeting and modeling. So we want to improve, we want to grow sustainably, we want with impact. So we need a memo stating the deadline, brainstorming session next week, decision on new products in 10 days, decision on funding structure in 25 days, and so on and so on. So you put a clear action plan so that departments, middle managers are involved and have clarity what they need to do. That's a better way of planning and budgeting and modeling. Then second step is strategic initiatives and key operation actions. So you need an action plan. Opening branches, cutting branches, new online channel, mobile channel, a new application for iPhone or for Samsung or for Android, actions, key actions. No analyst, no accountant, no financial specialist will be able to model if they don't know the key strategic initiatives and key actions and operations. And I will always stress that it's very, very important for a very good model. Department and financial plans. Per department, you ask your sales department to give you sales targets, portfolio disbursement and repayment, and I'll show you tables. And you ask as well the marketing department, which already discussed with the sales department, what is the marketing cost and advertisement cost? Yes. HR department, how many new people will recruit? What will be the average salary? Will you lay off people? Yeah. You need all the details. Collection and recovery department, don't forget about them. It's not only about lending money, it's about collecting money as well. This business is about collecting money as well. How many lawyers, subcontracted or in-house? You need all those inputs. Without those inputs, the model is not realistic. So you collect, then the next step, you collect all the data, you have all the department input, key actions, key operations, key strategic actions, new products, portfolio disbursement, repayment, collection and recovery. IT plan. Do you need a new server? Do you need a new backup system? Are you moving to a new software? Are you improving existing software? What is the price per hour for a new programmer? So you collect all the data. That's easier. Collection is easier if you have. You collect all the data and you input in your model. Let's assume you have already a developed model. And after that, you go and discuss with your department. So, okay, super guys, you're growing, you want to grow by 40%, but when I put as a CFO and with my team of financial analysts, when I put all the data in this model, I get to very, very high growth or very, very high unrealistic profit, or I get to a loss. And you start to discuss what to cut. Yeah. Or what are the priorities? Let's be positive. What are the priorities? Yes. And this is also very, very important to hold these discussions with departments. And you need the mediator to negotiate between sales and finance, between collection, and finance, or between marketing and sales, and so on and so forth. Because everybody wants a very big budget. The marketing guy wants, 1 million euro to put on Google advertisement, but you cannot monitor the impact of Google advertisement on your sales. So you have these discussions, you agree, and you do some stress tests that if you increase the interest rate, you have a high profit. If you decrease the interest rate, you need to grow the portfolio by 10 million euro or 1 million euro. And then you go for approval. You go for first approval to your board with a summary presentation. And maybe you repeat this process again, which is what is happening. Yes, the board will say, no, we're not satisfied about the profit and growth. Or we're happy with impact indicators, or we're not happy with impact indicators, or want to do more, want to take more risk. There are different microfinance institutions. Some of them are really oriented to working with unbankable, so they take more risk. And some microfinance institutions which are very commercial, and they move to high profitability, high margin products. They'll even stop some products in this financial planning and financial modeling sessions. Okay, so strategic planning, operational planning, financial planning, and then financial modeling. Okay, so you have all the details here for every step. Yeah. Now, you need to decide if you build a model or buy a model. If you build a model, you have flexibility. You input design table as you want, output of design of the output tables and information as you want. It might be the same financial statements that you are using, the same design, they have the same structure. You can do direct cash flow with details as you need. For financial institutions, liquidity and cash flow management is very, very crucial. So you can do detailed cash flow planning. You can add financial indicators and impact indicators as you need. You can automatize as you want. You have faster input and historical data. But time and patience is needed when building a model. Yes. It will take time. But every year you'll improve. I mean, first year will not be ideal. Second, third year will be ideal model. Now, buying a existing model, fast to use after a short training, so you need to make sure that you pay for the training as well. It's a professional app developed by a team. I hope they have manuals. If they have manuals available, this is also very good. If they have case studies, it's less flexible. Financial statements and other output tables will be in different format compared to your national financial statements format. It may cost more in terms of money, not time. You may be limited and locked to the programmers. So if you want to adjust something, you'll need to go to pay programmers per hour. So what I know Microfin for microfinance institutions, and you can basically contact them if you need Microfin to be used. This is what I know for microfinance. For social and impact funds, there are no standard model, but if somebody is interested, I have personally a model for social and impact funds, and we can help you use that model. Now we're talking about financial modeling process again, which is different than financial planning. Yeah. So financial modeling process includes the architecture of the model. The architecture of the model, the design of the input tables, the design of the output tables, design of the calculation tables, and then you need to write, formulas for the calculations. You need to test your model, test the model, not the business model of microfinance institutions, but formulas and how the input and output works together. And if your assets and liabilities gets equal, and if you PL show correct result. And then you need to approve the model, and you can go again iteration by iteration and repeat quarter by quarter or repeat year by year and improve your financial model. Now, level of details in the financial model matters. If the MFI is small, you don't need too many details for the first year, because again, you don't have a large financial analyst team and programmers team. You have, I don't know, the accountant, the CFO. If you have a CFO, you have a financial analyst. So your team is very small, 2-3 people in accounting and finance. And for mature MFIs, or as you grow, you have disbursements by product, for example. You have portfolio outstanding, you have portfolio quality, you have provisioning policies, you have interest rate by product. You have a different level of details. With the option one, which is the most simple, it's like you have average disbursement and average repayment. So you take an average repayment schedule and you link the average repayment schedule and average interest rate with your profit and loss account, and you have average inflows and outflows. So you link the average inflows and outflows with the cash flow, and then you have interest rate risk if you have floating interest rate or fixed interest rate, and some maturities. And you add ESG matrix if you are highly impact and social MFI, and you try to model those key ESG indicators in your financial plan and financial model as well. Because if you say you're planting trees, you need to know how much money, how many trees you plant in your community. Or if you say you're helping a sport team or helping kids in education, what is the total budget that you allocate for helping those kids in those schools? So ESG matters for both options with high level of details, and an option with a limited level of detail. So in option 2, you need information per products, per branches, per channels, online or partners or hybrid or branches. You need risk model like interest rate risk, currency risk, related parties, maturity, and also ESG. Okay, so financial model, if there are top managers at this training, financial model is an investment for board members. It's not an upper cost. It's an investment, and basically from the accounting, you can actually move it in intangible assets if it's a nice Excel developed with formulas. So financial model is an investment because it is guiding you during your business journey, during your business life, 10 years, 20 years, 25 years. So you can be capitalized on intangible assets from the accounting point of view, but from the business point of view, it helps you to faster stress test on key risk and opportunities. It helps you to make important decisions. So your success depends on your team, but also on your financial model. Now, financial model structure in details. Content. So kind of think about this as pages in Google Sheets or in Excel, okay? So you need the content so that you easily navigate. You need the setup of the model with products, items, financial statements, branches, key assumptions like GDP, interbank rate, interest rates, average interest rates on the market, average interest rates on the product. Products and disbursements, you need disbursement plan from your sales department. Network and staff. How many staff members? Then you go to calculation. So calculation per each department and branch. You can have portfolio quality, funding, debt or savings products, capital expenditure. Then you go to calculating interest rate income on portfolio, interest rate disbursement fees, portfolio at risk, loan loss reserves, loan loss provision. You need that. You need that. When you start, you start with a noble mission to help migrants or to help people with disability or youth unemployment, but they don't repay loans in time. So we need provisions. Your lenders, your shareholders will ask you about that later. Recovery, how much will you recover from the bad portfolio? Funding needs, when do you need additional liquidity? There is seasonality in lending business. You might need more liquidity in March, more liquidity in September, October. So you need a detailed projection. And I'll show you tables for every of this, okay? You receive tables. Okay. Financial results, and then what-if analysis. You need what-if analysis so that you can look at the impact. If you increase the interest rate, what is the impact on the profit? What is the impact on the cash flow? What is the impact on disbursement? If you decrease the OPER cost, what is the impact on profit? If you collect more money, what is the impact? If you recruit 2 new lawyers and they collect more, okay, what is the impact on collection and recovery income? And then the key output is executive summary. I always, when I analyze a financial model, I take first the executive summary. I take key assumptions as a summary and executive summary as the output. And I look at the key portfolio growth and the profit and the number of staff and channels, okay? You need financial statements. Ideally in the same format as you report to your stakeholders and government. And ESG table. Don't forget about the ESG table. This is a simple financial plan minimum requirement. Now, this is a detailed, because you have per product and per branch and per channel, you have details here. For smaller MFIs, as we discussed, you'll have some key assumptions on GDP, interbank rates, interest rates, and then you'll have one product basically, which is an average repayment schedule, average disbursement, and average interest rate. You may have network and staff if you have details and you have like 3 or 4 branches. Portfolio quality. So I have smaller number of sheets in a way in this model. But even for smaller MFIs, I recommend what-if analysis. And I recommend executive summary. And I recommend financial statements, including cash flow, including direct cash flow, not indirect cash flow, but direct detailed cash flow, because you need to manage liquidity. And those institutions which are managing very well liquidity, they're successful and they are moving quickly out of the crisis and moving successfully out of different crises. And those institutions which are not managing liquidity, well, not planning and not managing liquidity, well, they have issues. Okay. Any questions so far? No, let me look in the chat. No. Okay. Good. No, no questions so far. Feel free to write questions and I will answer. Okay, let me look. Okay. Okay. No questions, just comments. Okay. Again, as a summary, financial plan structure for smaller startups or early stage MFIs. or social funds, apply one loan product model. Average repayment schedule as key assumptions, and several key assumptions related to bad debt, like depending on the strategy, is it portfolio at risk like 5% or 25% or 10%. And then calculate from this bad debt share from the total portfolio, total loan portfolio, calculate provisioning. You need to calculate provisioning. I've seen several MFIs that started up and they don't calculate provision. You need to calculate provision for future losses. And of course, operational admin expenses, you have this usually. Nobody starts a business without computing operational admin expenses, but they are underestimated. There are higher costs in microfinance and social finance funds. As mentioned, costs with IT, cost with financial analysts, good financial analysts, and cost with collection and recovery. And training cost. You just recruit loan officers and you put them on selling loans to experienced SMEs. They're not trained well. So I have cost with training. It's good that SIFTA is organizing training free of charge. You can join, but make sure that if you don't find a subject on SIFTA training agendas, or webinars, then you budget some training costs and you train your staff. It's about people at the end of the day. It's about training. It's people training people to have good skills, and people's ambition as well to develop a financial institution in a very competitive environment in Western Europe. The financial market, banking, lending market is very competitive. So you need to find your niche and budget accordingly so that you become successful. Okay. Olivia, may I ask you to put the quiz, the poll, the questions, so that colleagues will ask what type of model are they using? Developed in-house or built by third parties? Software as a service or software product that was bought? Software that is used for free? Basically developed in-house. So far the answers. Dear participants, please answer questions. Built by third parties and improved in-house. Okay, good. Okay. So basically, majority developed the model in-house. That's a good strategy. It's a good strategy. 88%. Okay. Thank you very much. 88% developed in-house. The question was, what type of financial model are you using? Developed in-house, built by third parties, and improved in-house, 25%. Software as a service, one answered. Software as a service, good. Software product that was bought, okay, two. Software product is used for free, one, okay. So we have variety, but the main answer is developed in-house. So you are using your own model and you want to improve it. Great. Let's continue. Input. Well, we start with core assumption. We start with the market. Is it market growing? GDP grows. I mean, if you have GDP of the country, that's fine. But if you're starting a business in a region, maybe you have GDP per capita in the region. If you have details of the region, look for details of the region closer to your markets, okay? In some markets, remittances are playing an important role. So look at remittances. Now, don't pay attention for years here. So you need to plan for at least 5 years in the future. Inflation rate, okay? currency, local currency vis-a-vis USD, vis-a-vis euro, interbank rate, local interbank rate, international interbank rate, euro, treasury bills, LIBOR, Euribor, social fund tax rate, profit tax rate. Is it changing? Is it not? Is it the same? So key macroeconomic assumption, a simple table like this one, okay? I think it's doable. Everybody can do it. Let me see if there is a question. Okay, no question, just comments, appreciation. Okay, so you can develop this. That's pretty simple. Probably you have only interest rate. You want to add additional numbers because you need to monitor those numbers. You need to be proactive because you need to watch this. You're reading financial statements. You're reading financial news. You're looking at your competitors. You're looking what's going on in the regional market globally. So how the regional crisis will impact your business, or how the country crisis will impact your business. So you need more details. You can be creative here. You can brainstorm and add other indicators. If remittances for you is the key indicator, then look only at remittances. If EU funding in your geography is the key indicator, look at EU funding budget for next year. So factors that will really influence your business, or municipality support to small business. If that's the key factor for you, then look at it and budget for it, okay? Okay, let's continue. Now, loan portfolio, what we are doing, we are portfolio managers. We're building a portfolio. We're allocating money, our money or lenders' money. We need total disbursement, and we need growth of the disbursement, and we need growth of the portfolio. And here, attention please, some MFIs are budgeting only portfolio growth. That's not enough because you have early repayments. Of course, you can have late repayments too. You have early repayments and late repayments, and this is disturbing your cash flow, and this is disturbing your gross portfolio ratio, GLP, gross loan portfolio here, shortly. So budget for disbursement. You budget only for portfolio. You allocate the key numbers portfolio to your sales force, and then they say, oh, we met our portfolio targets, but clients did early repayments, clients did late repayments, but you have not given the message to the salespeople you need to do new disbursement, and you're not meeting your income budget, you're not meeting your profit budget, okay? So budget disbursement and budget GLP. Another benefit of a very good model is that actually you can distribute the targets per department, per middle managers, per loan officers, per collection and recovery. After you approved this model, you use the model, the data from the model, to set up the KPIs of your team. And you even put the KPIs in the working contract or labor contract with them, and you have clarity in your institution. I'm advising different institutions working with not only online, but their offices. People, they don't know what their targets are. They have a general target. We want to double. We want to be the best growth bank. But they are middle managers, they're loan officers, they don't have the details of those KPIs. That's the beauty of a good model. You can distribute the corporate objectives and targets to your departments and staff. Okay. Average maturity, you need that. Use the months, average maturity in months, okay? You want to do long-term loans, short-term loans, you can do an average maturity, you can have a weighted average, how many short-term loans, 1 year, how many loans like for 3 years, for 5 years, for 10 years, depending on your product. So you can do a separate detailed table if you want, and then calculate the average here. Revenue, interest rate. And look, in mature markets, I've seen MFIs with 10% interest rate. Now, how you can make profit from 10% interest rate? I mean, you shall be very, very, very productive. You shall issue a lot of loans per head of salesperson. Now, how you can increase your revenue? That's an important question for the sales managers. Okay, you as a financial analyst, you say, tell me the interest rate. Salespeople tell you 10%. You enter here and you show, without making a profit or making very small profit. You can use weighted average interest rate, weighted average disbursement fee, other fee income if you have, penalty income. You can break down penalty income by portfolio at risk, and arrears, number of days in arrears, or you can use simple like a penalty for bad portfolio in general. These are revenue assumptions. Any other revenue, unless you have, again, a micro equity product or revenue or sharing loan, you can have dividend income here or, royalty fee. I mean, different sources of income. If you charge like for training your SMEs, feel free to add the training fees here, whatever fees you have, revenue. You need to have revenue to be sustainable long term and to keep the value of your owner's equity money, to keep the value of the shareholders' money. The owner's equity gets eroded in a high inflation environment. If the inflation is 7% and your interest is 10, oh my God, you have only 3% margin to work. And this is for upper cost, for loan loss reserves, and for future profit. So think about revenue assumptions. How you distribute your portfolio, number of branches, number of HQs, headquarters staff, number of branch staff, number of loan officers, number of online channels or or people in the online channel, legal and collection staff, and then total staff. So you need to forecast how many people you need. And the key issues here is to increase productivity. Basically, speed of delivery is one of the core advantage of the business. So how you can increase the productivity. So HR assumptions. Portfolio at risk. Again, details here. I'm presenting, best ideal model with the details. So portfolio at risk per number of days in arrears, like 1 to 30 days, 31 to 60 days, 61 to 90 days, yeah? And then you calculate total par more than 30 days, total par more than 90 days. You can have par more than 1 day as well, and you forecast. Now, somebody will say, is this an input or an output? Well, the percentage may be an input, might be an output, depending on how you structure your model. If the amount is input, then the percentage will be an output, amount of money in arrears from the portfolio. Depends how you structure. Important to keep track of how you structure so there are no repetitive formulas. Restructuring, do you restructure your portfolio? No, when you start the business, you never think about restructuring. When I started Microinvest, I never thought about restructuring. Now, restructuring is happening every year in every bank or in every microfinance institution, microcredit provider, or mezzanine fund. So you need to forecast the restructured amount, because the restructured amount is impacting your cash flow. Your cash flow will be smaller. You need to borrow more money to lend and achieve a disbursement plan. So you assume no restructuring, and suddenly, bah, you have to restructure 10% of your portfolio, which means you need 10% more money, funding capital, equity or debt lending capital to support your growth, because then your loan officer salespeople will say, well, fine, I have my target, I prepared the loan application, my client is waiting, give me money to disburse. And who's responsible for fundraising? Well, CEO. If CEO have not delegated to the CFO, or CFO have not delegated to the fundraising department, then it's always CEO responsible. So make sure that top managers which are presented here are delegating clearly to departments and they're budgeting new funding needs. Write-offs. You planning to write off loans? No, never. When we start a business, we don't think about writing off. It is happening. It's happening, and in crisis, it's happening. It can get to 10% or 20% of your portfolio. Okay. Recovery. Do you plan to recover something from the write-offs? Yes, we want to recover. Do you recover 100%? Never. You recover 25%? Maybe. If you have good collateral, you recover. If you have no security, there is nothing to recover. The client is gone and moved from Poland to London or from Romania to Paris. You need to find the client. So collection and recovery rates. Write-offs, yeah, cumulative write-offs, cumulative recovery on loans from the beginning of the activity of a particular year. How much do you plan to recover in percentage and in amount? Loan loss reserves, yeah, for those that are new to this business. So loan loss reserve is a reserve needed for future losses. How do you estimate the best reserve? You look at your collection history. If you don't have collection history and write-offs history, how much money you lose. Then you look at the market, how much money the banking sector or non-banking sector lost last year. So you try to use a benchmark from the market. And you budget a reserve in the assets, but you also budget an expense in the PL. Which hopefully will never materialize, but you need to budget for the current year to present a realistic profit. If you don't lose any money in this year, fine. If you don't lose money next 5 years, fine. But I haven't seen such MFI so far. Now, borrowings. You need capital for lending. Borrowings. Now, do you take borrowings as a percentage of total assets or total liabilities or as an amount? I mean, there are a variety of possibility to to budget. You need to first probably start with equity. What is your current equity? You have like 1 million euro equity. You're planning to have like 80% debt in total assets. Do you plan to increase the equity or not? So how much money you need for next year for lending capital, and what is the average interest rate for your borrowings? Is it 8%? Is it 5%? Is it 2%? Where do you plan to collect your lending capital, and how much will cost you? Is there any commission? Yes, might be. If you're borrowing from abroad, is there any withholding tax? Yes, it might be. So you budget all the numbers. Do you plan to collect savings? Okay, fine. So from all your liabilities, 80% will be borrowings and 20% will be savings in this example. Then it will change like 70% borrowings and 30% savings. Deposits account, you're opening deposit accounts for individuals. And what will be the amount? You have the amount here. Weighted average interest rate, how much do you pay for 1 year deposit? Weighted average interest rate. If you're a social fund and you don't have savings and deposits, you have investors, then you have an expected rate of return for your investors, either dividend or yield. If it's a bond, it's a yield on the bond. It's if a share, then it's a dividend on the share. You don't pay it annually. Maybe you'll pay in 3 years, but you need to budget for that. Again, I'm focusing here on an institution which is providing loans, like a microcredit provider. If somebody is interested in equity or mezzanine products, I have a different model, and we can discuss with you. You can apply for SIFTA training, or we can find out the solutions. Product. How many products do you have? Do you have a consumer loan product? Do you have mortgage loan? Do you have a business loan? Do you have a startup loan? Do you have a loan for women? Do you have a loan for agro-food, for agriculture? So different loans and their share in total portfolio. Yeah, their share in total portfolio. In total disbursement as well. Share in gross loan portfolio, share in disbursement. Average loan size, disbursement and portfolio. Average loan tenor months, yeah, period. Weighted average interest rate, and disbursement fee. Now, you also need to do probably a product profitability exercise, and those products which are not very profitable, if you're a profit-oriented institution, you need to exclude that product. If you have subsidies and you have a very strong social mission, your shareholders, municipalities, or government wants you to take a very high risk, then you budget, 10% interest rate. If they're covering your cost, they may have upper cost subsidy for you. Disbursement fee, you can add disbursement fee here, or again, upper cost subsidy or interest rate subsidy from the government. I think it's pretty clear with the product here. Now, I prefer to budget as well number of clients, because number of clients gives you diversification. You can also use number of clients as a KPI for your salespeople. So budget number of disbursed loans and number of active loans in your portfolio. And now, of course, you may have number of clients as well, because one client may have 2 loans. It's getting complicated. And some institution number of loans will be equal to number of clients. In other institution, number of clients will be smaller than number of loans, because one client has 2 or 3 loans. So a budget number of loans disbursed in this table. And yeah, we're moving. I mean, our model is getting more and more complicated. Now, moving to portfolio disbursement and repayment. If you have a good software, you can extract for the last year repayment. And you can also estimate repayments of your existing portfolio. So you know what I mean? I mean, you've issued last year loans for 3 years. So repayments are coming every month, not on the same amount, not equal amount. You may have different repayment schedules. But if you have a good accounting and portfolio management software, then you can extract from the model repayments. And then you have the new disbursements and new portfolio, and you budget new repayments, yeah? So you budget repayments per month and per year. I prefer budgeting repayments per month and per year. In a simple model, you can do like all repayments per year, but that is not helping you in managing monthly liquidity. So do monthly repayment and disbursement forecast and annual. Okay. I'm sorry. Okay. And if you have disbursement and you have repayments, you have what? You have outstanding portfolio per year and per month. This is calculation table. The core business is managing our portfolio, so please do monthly and annual disbursement, repayment, and outstanding portfolio. Well, On the calculation pages, you may want to partner with a specialized person on formulas or even on Visual Basic or other softwares, programming softwares that I use nowadays. So a programmer will help you a lot to improve the model. Do not insert data in the formulas. Try to use different cells for different data and then link all the cells into a formula. Don't make long formulas. Create additional separate calculation pages or tables instead. And test. This is the key message. Usually it's actually one person building the model, which it's not good. It's not good. You need 2 or 4 people at least. In a small MFI, 2, in a big one, 4. And I'm talking here about programmers only, about a team, with a project manager, with, a tester, with a coder, team. I believe in team. And every year you'll improve. If you don't have enough staff members this year, you'll recruit next year. So next year, ask the newcomers to challenge your model. And they go into your model and they'll spot some mistakes or some improvements or some information missing. Validating the model. You need to validate the model, calculate, and you do some separate spreadsheets, separate sheets in Excel or Google Sheets, and see if it gets the same result or different formula to get the same result, okay? Now getting to output. I like this output. It's very straightforward. It's like number of branches, percentage of clients reached or served online, because this institution has the strategy and key action to move online. So they wanted to track percentage of clients reached and served online. You have value of disbursement, you have gross loan portfolio, loan loss reserves, total assets, borrowings, savings, and current accounts, and total equity. So you have like outreach key indicators, balance sheet key indicators, then income statement, like revenue, financial cost, total provision, other financial income, net margin, total operational cost, net income from operation, and net income. And this is what I was saying. I was challenging you guys how to make a profit from a 10% interest rate without any fees and any other sources of income. You need to cover financial cost or cost of your liabilities and borrowings, savings and borrowings. You need to cover provision expense, future loan losses. You need to cover worker and admin cost. And you need to satisfy your shareholders with a return on equity they expected return on equity. Not an easy task. Not an easy task. Okay. Also key ratios. Growth of loan portfolio. Everybody wants to look at growth of loan portfolio. Portfolio at risk ratios, write-off ratios, loan loss reserves, recovery rate. Then you go to return on equity, return on assets, cost to income ratio, and details on yield on portfolio. Because your sales staff will say, look, we disbursed, we met our disbursement target, we met our portfolio target, but then you as a financial analyst look and say, yeah, that's fine, but you have not met your yield on portfolio. And why? There are different answers when you look at budget variance on yield on portfolio. There were some mistakes in your model when planning yield, planning interest rate and fees. There were some big repayments. There were some late payments. So these are the key. You did some restructuring and they did not pay the interest. You did restructuring on the interest as well. So actually you delayed the interest payment. So your yield managing financial institutions in a way is simple. It's like managing the margin between interest income and interest cost. It's simple when you have this table, but in reality, if you don't have a financial model and you don't manage budget variances weekly and monthly, you're not able to understand where the problem is, and you're not giving proactive messages to salespeople, to collection and recovery people, or to other departments like online advertisement department or marketing department. Do you need new equity? Well, based on leverage effect, like 20% equity, 80% debt. If you're lending more, you need more equity. Yeah. If you have 200K equity and 800K debt, and you want a 5 million portfolio, you need to increase the equity. How are you going to increase the equity? That's another issue for microfinance entrepreneurs and startups. You need 2 or 3 shareholders. Don't need to rely on one shareholder. You need diversification basically on the shareholder structure as well, unless you have a very, very wealthy shareholder, which is government or municipality or individual. Okay, any questions? Okay. No questions. Let's continue. Related to output pages, use your standard financial statements that are used in your management information system. Use your standard financial indicators formulas, including indicators used for covenants with creditors. Okay, covenants with creditors. Use some group on group function to shorten for presentation purposes. Yeah. Better visualization of output, use Microsoft. If you use Microsoft, use Power BI. Use budget variance, Power BI, for those that are not using it, is a business analytics service. It aims to provide interactive visualization and business intelligence capabilities with an interface simple enough for end users to create their own reports and their dashboards. I'm in favor of standard reporting, not smart reporting. Smart reporting is good when you design, but if you give smart reporting to every financial analyst and to every manager, they will get different results, and then it's getting complicated. So you need to set up some standard reports that everybody is using by clicking a button. But again, you can prepare those reports in Power BI. You can set up Power BI, and then they can use it. Okay. Now, if we have a nice model, we can do stress test. We can do stress test. One factor stress test or multi-factor stress test. And this is a nice table to be used by you. You have like your budget here. And then you have like low impact multi-factor stress test, and then medium impact multi-factor stress test, and high impact stress test. And you show if interest rate goes up, inflation goes up, what's going on in your business on every aspect: number of branches, number of clients, gross loan portfolio, revenue, cost, loan loss provision. If you open a new channel and you attract more clients via the online channel, what is going on your profitability, on your key ratios? So this is for you a template to be used, multi-factor stress test. Now you can stress test on different aspects. You can stress test on war or crisis, or electricity shutting down, or your software not working, or buying a new software, how much will cost. So you can do a variety of factors that influences your business. What is important for you is look at risk and opportunities. So don't look only at the risk of like disbursements will drop, but look at disbursement will grow. Don't stress only for portfolio restructuring of like 10 million, but stress test for new product, for green finance product, for example, or for mortgage loan, or for micro equity revenue participation loan product. So you add all the changes in your business and you calculate the profit, and then you calculate the impact of each variable, and you calculate cumulatively or aggregate the number of multi-factor impact. So it's a nice table. Use it to present to your shareholders. That means that you have worked on different scenarios, and you know what is going on and how you will react. And if disbursement will drop, you know that you need to cut your staff, you need to cut your branches, or you just wait 1 year because you have enough equity, and your equity can cover those losses for 1 year. But again, you have the trigger point that more than 1 year you'll not be able to cope with the crisis. So still you need to fire people, close branches, or restructure the business, or sell completely the business, or buy another business. If you're so good and you have enough liquidity, you're taking over a smaller MFI or smaller social finance provider, or merge. Why not? You can simulate for merging with another MFI, and you cut branches. You have 3 MFIs in the country. They all have branches. So you cut 3 branches. You cut 2 branches. You have 1 branch, or you cut all 3 branches and you go online. I'm in favor of hybrid model, but your markets, hybrid meaning online and offline, but you know better your markets and your regions and your districts and your cities and your clients. Ask your clients. Okay. So stress test is not only about risk and losses, it's about opportunities. Look always for opportunities. Keep positiveness in your company and in your numbers. Okay, we have a new poll. We have a few questions. Olivia, please help me with questions. I would like participants to answer. Did you discuss any worst scenario in December when you approved the budget for 2025? Was your worst case scenario discussed or approved? Was your best case scenario discussed and approved? Or you approved only a realistic scenario? Did you got into details, like really stressing your board that something might get wrong, but we're prepared because we simulated and we know what to do? Best scenario discussed, okay. Oh, good. You discussed also worst case scenario. Good. Good. Take your time to answer, please. And again, what level of discussions you had with your board? I know you don't want to bring negative info or news or bad news to your board, but by bringing bad news and explaining to them how you'll cope in this case of the crisis, in such a crisis, what actions you already have in mind, you got prepared. It's like getting prepared for, for an earthquake. We know how to get out of the building or of the hotel. It's the same for our business scenarios. We need to get very prepared. Oh, good, dear participants. You're doing well. I mean, you discussed both scenarios. Well, some participants did not discuss the bad scenarios. Okay, 25%. Okay, okay, good. We are continuing with stress test. Well, variables and their impact. You know that there are some negligible impact. You know, some variables will not affect your business, or there is very low impact. The probability is also very low, but there are like significant impact and high probability, very likely that it will happen next year. So hopefully inflation will start go down, but so far it's still very high. Hopefully the Ukrainian Russian war will be stopped and finished as we discussed if they meet in Istanbul, and this will have positive impact on energy markets and energy prices. But we don't know, and we need to get prepared. So I always think in this like impact and likelihood, and use the colors to present, and then your board will be very happy. But first of all, you will be confident on your next year numbers and your next year key strategic actions and key operation actions. You can stress test for portfolio growth, like increasing the portfolio, decreasing the portfolio, restructuring rate, you know, increasing restructuring rate, decreasing restructuring rate. You can stress test for different variables. And this is your table that is used in Excel for stress tests. So you can activate or deactivate one or another stress test or variable. So you can activate all variables or combination of variables. There are like 6 variables here, but you can add more if you want. So there is portfolio growth variable, portfolio yield. So you can simulate like portfolio growth and portfolio yield only. Or you can simulate for portfolio quality only. So you see on, this is only for portfolio quality. The rest of variables are off. So what we do, we basically simulate for portfolio quality. We assume that portfolio quality will decrease, or portfolio quality will increase by 20%. Yeah, ratios. Portfolio at risk ratio. Excuse me. And you see multi-factor stress test here. All the variables are on. And for portfolio quality, actually, you can add the other variables, not only restructuring rate, but not only portfolio at risk ratio, but write-offs as well and restructuring rate. So can be very creative here. Well, liability structuring, if your lenders are not giving you any more money, you have a contract, but they're not disbursing, or vice versa, you need to repay to them and you don't have liquidity. So you can have different scenarios on, you know, it's a crisis, restructuring rate went up, portfolio at risk went up, we don't have 1 million euro to repay to lenders. So what do we do? Now, if you call them now and say we don't have 1 million, that's too late. That means your financial planning, financial modeling, your management team is not working, or is working but did not tell in advance to lenders. What lenders prefer is they prefer to see a management team where they come and say, look, we're doing okay now, but we see that in 8 months we'll have a problem if we're not refinancing our liabilities, because we restructured our portfolio in conformity with our current loan agreements. We have the right to restructure up to 10%. What we're planning to restructure more, would like to ask you for a waiver. So please ask your board to waive some limits. So it's always good to be proactive, and financial modeling and stress testing is helping you to be very proactive. Okay. We have another poll about your board. Oh, that's okay. Did you restructure? Yeah. Yeah, no, this one, yes. Is your board open to discussion? Well, some board members, they say, well, I don't care about scenarios. I just want a realistic model that you'll achieve next year. And you'll need to discuss with your board openly that there are some risks in the market, and you as management, you see those risks and you want to discuss it. Again, board members would like to see only growth, double-digit growth, double-digit return on equity, but it's not happening always because of different situation in the market. So the financial model will help to show them, yes, there is a risk, but yes, there are also opportunities. Okay, so there are some participants here that never asked, never discussed with the board. Yeah, depending on the board as well, depending on the board. Okay, 80% is open to discuss different scenarios, but 20%, there are some issues. Good. Manuals. Well, if you develop a model with your team and the team is leaving your company, you don't know what to do with that model. So you need manuals. You need manuals how to rewrite the model or program or write formulas. And you also need users manuals, but also how to program, to develop, to code. So involve more people, including external specialized firms to, write manuals for your financial model. And again, it's an investment. It's not a cost, it's an investment. Basically, in some accounting jurisdictions, you can capitalize it on intangible assets. So it's an asset, it's an investment. We're moving from one company to another. People get bored, they get married, they, go to other countries. It's good now you can work remotely, but make sure that this risk is minimized and you have at least key information and passwords about your financial plan and your financial model. Okay, any questions? We arrived at the end. In conclusions, analyze your financial models and conclude if you have a stress test of sensitivity, if you have what-if pages, if you have summary pages, you have the menu, do you have ESG tables, analyze key assumptions, every year, different variables. It's a dynamic model. Even every quarter, something may change. So you may want to add a variable there in order to stress test. Portfolio at risk will be always there. Restructuring rate will be always there. Sales growth will be always there. Average loan, loan products, you may want to add a new product and you see the impact. You also would like to model that you sell the business now because it's too late, it's too competitive, or that you want to buy now another competitor at any price or at a reasonable value. So you can simulate, you can have some specific models, product profitability models, which we have not talked in details because we have only 2 hours. But think about your strategic vision, strategic mission, operational plan, and then adjust your models accordingly. And serve your clients, and your clients, if you're a financial analyst or financial department, your clients are top managers on board. You need to serve them well. Diagnose your financial model, how big your formulas are. Withdraw all data from formulas and insert separate in a cell so that you can change it, stress test it. Link all formulas to data cells. Build a separate page or model on each factor for stress testing, then a summary for multi-factor stress test. Stress tests electronically, like calculations, spreadsheets, enter into bank IT system, change intentionally interest rate for one existing client, or change, something and see how it works. It gives you an error or not. Stress test physically check if your fire extinguisher works, or if your server backups work, so if your top management is not traveling in the same car or airplane or same bicycle. Do they have the password to this model? Can they work remotely on this model? Can they access this model remotely? So this is an example of real stress test. We discussed the process, go by this process permanently, like model the architecture and improve the architecture every year. There is the core, and you can add. You can start with the average repayment schedule, like one product, mono-product microfinance institution. And then actually you can set up a new spreadsheet. You add 3 products, and then summary from that sheet goes to your current model. So you can better design. You can do better design. You can improve calculations. And you can input automatically data actually from your software, or core banking software, or portfolio management software. Remember, on repayments and disbursement, you can input automatically data, so you can automatize. And then go to top management, approve, and go back and adjust. So it's a dynamic model. It's a continuation of improvement, continuous improvement every year. Use risks and opportunities. Okay, don't forget about this. It's a nice output. Make a financial plan and budget a working tool. It's not something just to show to lenders, a working tool. Make your stress test a working culture. User experience, user interface. This Excel shall be nice, shall look nice, shall be user friendly. Everybody shall usually work with it, even a new recruit, new economists or new statistician shall work easily with it when it comes to your company, when it is recruited. Build risks in it, build the ESG, work with ESG specialists as well. You can actually build a software from it if you want. You can program it in something else, in, I don't know, C++ or Python, or whatever language where your programmers know. Now, at the end, I'd like also to ask you to complete one questionnaire. It's very, very important for us. How close are your MFI actual data to the approved budget? So please answer. Your MFI's actual data vis-a-vis the financial plan approved, okay? Financial data vis-a-vis financial proof. Variance of a plan, yeah? VOP, variance of a plan. I'm sure you all use variance of a plan, yes? And it's good for the beginning to have big variances. But every month, every quarter, you improve and you correct and you give clear messages to your staff. You are in the same boat and you need to receive clear messages where you are. I know some top managers don't want to share that there are some problems or issues. Maybe you don't want to share at the beginning to get prepared, but you need to share with everybody about opportunities. And okay, so the bigger number of participants is in the 10 to 24% variance of a plan, usually plus. Okay, good. So you're outperforming. Oh, it goes to minus as well. Okay, outperformance, underperformance. I know there is this situation when your board or your top management is linking your bonus to your financial model and financial plan results, financial results, and then you try to do a very pessimistic model. But you use this model for improving. Don't use it for bonuses. Use it for improving your business and becoming a leader in the region, becoming a leader in your field, serving micro enterprises with good quality, with good products, and making a profit and impact as well. Okay, so there are institutions which had like 50% variance of a plan. Okay, you need to look back. If you have a model, you need to look back what went wrong on interest, on disbursement, on portfolio, and recovery. If it's on quality of portfolio, then you need to go back to your credit worthiness, credit scoring materials and policies. Please join tomorrow credit scoring, because it's always on quality. It will always start with quality. There are some liquidity aspects as well, some fraud aspects in some cases, but it gets to the quality of portfolio. It's a funny business. It's a funny business. If we are happy, we earn 10%. If we're not happy, we're losing 100%. We're losing the principal. So it's a very, very strict business, and we need discipline in this business. The mission is nice, the impact, the social mission, but those clients, they need to pay back. Maybe those clients, they don't need a loan, they need a job. They need a job first, and then a loan. Thank you very much. So yes, yes, there are minuses, minus 25%, minus 50%. Okay, good. I hope this helps you to improve, and I'm always happy to answer to your questions now or later. Let me see if there are some questions. No questions anymore. Okay. Appreciate. Good luck, and always call me or ask MFC for help. We are happy to help improve your financial planning and stress testing. Thank you very much. We're waiting for you tomorrow at the credit scoring, and credit scoring will be not only for microcredit, but I can touch subjects for new products like micro equity or revenue participation loans. So really encourage other colleagues to join, top managers, but also middle managers and juniors to learn. Thank you very much. Have a nice day.